Hello, friends. Welcome to the YouTube channel Learn Finance and Accounts. This channel is dedicated to the efforts put in by teachers and students in teaching and learning finance and accounts. So, in the previous video, we had discussed about cost of capital through the source debt. In this video, we are going to discuss about cost of capital through the source, which is equity. So please watch the complete video, like, share, and subscribe to the channel so that you can continue getting updates. So just to have a recap of what is cost of capital, the cost of capital of a firm is the minimum rate of return expected by its investors. Now, cost of capital is the cost that we are paying for raising finance or capital through different sources. These sources are debt, preference share capital, retained earnings, and equity share capital. In the previous video, we had discussed about cost of capital through the source debt. In this video, we are going to discuss about cost of capital through the source equity shares. Now, equity shares means when we are offering to the general public ownership of our company, a part ownership of our company, then this means we are issuing them shares. So before knowing about cost of equity, let us first recollect what we know about equity. Equity is a part ownership. So when a person purchases the shares of some limited company, then the person becomes owner of that company. But the ownership is limited up to the number of shares purchased by that person. So we will discuss about the features of equity. Before discussing the cost of equity, let us discuss about the features. See, there's no fixed cost or return. So when a person becomes the owner of a company, then the person will not get any fixed return. If the company makes a profit, then the person can expect to get a part of the profit in the form of dividend. This dividend is not fixed. Sometimes dividend is there, sometimes it is not there. Sometimes the whole of the profit is distributed. Sometimes the company thinks that they should keep some part of the profit with themselves for future requirements. There's no tax benefit. Tax benefit is not there. Why? Because we know that dividends is paid on profit, net profit. When the profit is there, then the dividend is paid. And in case of say cost of capital raised through debt, then interest is paid. So interest is a type of expense. It is already debited before calculating the net profit. And on net profit, a tax is paid. So there is no tax benefit in case of cost of equity. Voting rights are available to the investors. Investors are owners of the company. They have the equity of the company, so they become owners. If a person has shares of a company, he is the owner of that company, and that person will be invited to the annual general meeting, and that person will be able to have voting rights and interfere in the management. Whenever a management has to take a decision of starting a new venture or how much dividend is to be paid, then this person can decide to interfere in the management. But interference will be possible only when the person has substantial number of shares, but still voting rights are there. So, say a group of investors or a group of shareholders can get together, and if their total equity is more than 51%, then they can have their own decision. Now, in case of interest, in case of debt, we knew that what is the rate of interest that has to be paid to the bank or the money lender. So interest was fixed and it was known. But in case of equity, dividend is not known. How much dividend is to be paid, the company does not know this. And the investor also does not know what dividend is the investor going to get. So if we do not know anything about the amount of return, it becomes confusing as to how to calculate this. If you are finance manager of the company, how will you take this decision? Ki how much dividend should be paid? In other words, there is no price tag on the amount of equity. Price tag. What is price tag? Say if you go for in a shopping mall and you purchase a dress, when you come to the counter, you pay for that dress. How much payment you have to do, and how do the person at the counter know how much money has to be taken? That is checked from the price tag of the dress. So when the tag is there, then you as a consumer also know how much money is to be paid, and the person at the counter also knows how much money is to be taken. So in case of debt, there was a price tag, rate of interest. It was there in case of preference shares capital also. You knew what percentage had to be paid as a finance manager. But if price tag is not there on equity, there's no price tag. Then expectation becomes a tag. Now, when you purchase a dress, you have some expectation. Ki I will wear this dress for a party. I will wear this dress as a night suit, or I will wear this dress in the office. So then that expectation becomes a price tag. Expectation becomes a tag in that case. Now I'll give you another example. So say after 1 year, you will be searching for a job. You have completed your degree, so you search for a job. As a fresher, you will not tell a company how much salary do you want. See, if you get a appointment letter from a company or an interview letter from a company, you will go there and give the interview. If the interview is successful, then the company tells you that you are appointed. But will you be able to bargain? Y- Yes or no? You will not be able to bargain because you do not have a price tag. Now, suppose there is another person who is also working for some other company. He also comes for the interview, and he is drawing a salary of 50,000 per month. Then that 50,000 per month is a tag. And now when this company says, okay, join our company, and if the person who has given the interview says, okay, I will join this company, but I will want a 25% hike. 25% hike on what? On the 50,000 that he is getting. So the price tag is there, but a fresher will not have a tag. But still, there are some expectations. What are the expectations of the fresher? So the company says, okay, you have to come to Bangalore or this city, and you have to report in this branch. So the fresher will think, okay, if I go to another city, these will be my expenses. I will have to live as a PG. I will spend this much money on going to office, on food, on rent. So he does the calculation, and he comes at a figure. Ki minimum I should get this, then only I will be able to join the company. So this is the expectation. So in the case of equity also, what is cost of equity? It is calculated as per expectation. Another element that plays a role is the growth. Now, if the company tells you you have cleared the interview, will you join our company? Then you will think, okay, I will join, but let me also think that people who are already working in this company, they get promotion after every 1 year or after every 2 year, and they get an increment, and this is the bonus that they are getting. So you think about growth in that company. So growth also plays an important role in whether you are going to join that company or not. Similarly, the person who purchases the shares of a company, that person is also affected by the element called growth. He also wants to know how the company will progress, or what kind of dividend he or she will be able to get, say, after 1 or 2 years. So that all depends upon growth. So the cost of equity is calculated in two ways: without growth and with growth. It is calculated by the formula KE is equal to D1 divided by P0. Now, suppose a company raises and receives equity share capital of PO. Suppose the share price is PO. It is also called P0. Now, what is P0? P0 is the price as of today. P0 is the price as of today, and it pays a dividend after say 1 year. That dividend is known as D1. So today rate of the share is P0, and dividend that it pays after 1 year is D1. So KE becomes D1 divided by P0. So D1 is the expected dividend and P0 is the current market price of the share. So we know now this is the formula D1 divided by P0. And when growth is added, then the formula becomes D1 divided by P0 plus G, where D1 is expected dividend, P0 is current market price, and G is equal to growth. Now let us do a small question on this. So that question will make everything more clear. So the company ABC Limited has just declared and paid a dividend of 15% on the equity share of 100 rupees each. So share price is 100 rupees. It was issued at 100 rupees at that time when it came into the market. Future growth rate is 12%. Market price of one share is 168. Now what is this market price? Market price is P0. Dividend, how much dividend is there? Or what is the dividend that the company has paid? 15%. So that is D1. Calculate cost of equity if the investment is done today under the two circumstances, which are with growth and without growth. So solution in case of with growth, the formula becomes D1 divided by P0 plus G. P0 is 168, D0 is equal to 15, G is equal to 12. Now let us calculate D1. So what is D1? D1 is equal to 15 plus 12% of growth. 12% of 15, which is equal to 16.80. Now when we put these values in the formula, K is becomes 16.80 divided by 168 plus 12%. This means KE is equal to 22%. It will be calculated as 0.22, but when we convert this into percentage, it will be multiplied by 100 and 22% will be the result. So that's all for this video. And this was a cost of capital through the source equity. We have done cost of capital through the source debt. We have done cost of equity calculation through cost of capital through calculation through equity. Now we will in the coming video we'll be calculating cost of capital through another source, which is preference share capital. So that's all for today. That's all for this video. We'll meet again. And before closing down this video, I'll again like to remind you that if you like the video, please like our channel, subscribe it, and also share it with your friends. In case you want to support us so that we can continue making such educational content, so you can support us by this QR code. So that's all for this video. We'll meet again. Thank you.